Labor's Matt Thistlethwaite and Liberal MP Scott Buchholz are both members of that House Economics Committee which was grilling bank CEOs this week. They joined me from Canberra just after the inquiry wrapped. Scott Buchholz, Matt Thistlethwaite, welcome to the program. When Malcolm Turnbull announced this inquiry, he said the banks would have to justify their actions in front of the elected representatives, and that will, I tell you, that will drive some cultural change at the banks. What culture did you change this week, Mr Buchholz?
Well, I don't think that there was any CEO who gave evidence over the last 12 hours in front of the Economics Committee who felt comfortable. I think what we've seen up front is a culture of an apologetic nature where all united have acknowledged where their failures have been, and I thought there was a robust couple of days.
Matt Thistlethwaite, what changed due to these hearings?
Well, I don't think anything's going to change, and that's the great shame of what's occurred over the last couple of days. All of the CEOs admitted that they'd done the wrong thing, that their financial planners, that their insurance arms, and that their general banking arms had been involved in wrongdoing. Hundreds of planners had been either dismissed or referred to ASIC and banned, and each of them admitted that there was a cultural problem, and in their views that these instances would continue to occur into the future. The only thing that this inquiry has achieved is demonstrating that the banks are out of touch with their customers, the Turnbull government is out of touch with the Australian public, and this inquiry is a very, very poor comparison to a Royal Commission and justice for victims.
I know Labor is pushing for a Royal Commission into banks, but surely politicians are the ones that make the laws. Making you guys prepare for this hearing, listen to people who've been ripped off and have got complaints about poor banking practices, must make you better legislators.
Well, this inquiry has been completely one-sided. We've heard from the bank executives. We haven't heard at all from the victims. And the discussions that I've had with victims and whistleblowers in the lead-up to today's hearing indicate to me that what's been highlighted in the media is the tip of the iceberg, particularly whistleblowers in insurance who've said that what's been highlighted is just the beginning. There are so many more stories of wrongdoing, and we're not going to get to look at those because we only had 3 days.
Scott Buchholz, one of the major drivers of this inquiry was when none of the 4 big banks passed on the RBA's rate cut in August. When the RBA cuts rates again, do you think the banks are going to pass all of that on, or do you think they'll just carry on as they were before?
I think all the banks were unanimous in their position that the cash rate of 1.5% is not intrinsically linked to their cost of funds. I think every one of them put up a reasonable argument that historically the cash rate would follow the standard variable, but with the cost of raising funds, I thought they eloquently put their case in that regard. So to answer your question, I wouldn't suggest that future rate cuts would induce a decrease.
I was listening to Brian Hartzer, the Chief Executive of Westpac, say that in the past 10 years, the difference in their profit margins over the net interest profit margins has decreased by 30 basis points over that decade, a drop of 15% for them. Yet at the same time, their profits have been like a rocket taking off.
There's no doubt that
Are you getting the wool pulled over your eyes? Is that that's what I'm saying?
Well, you can either have banks that operate in a sub-economic environment, i.e. US, UK, or you can have profitable banks like Australia, Canada. I know from an economic perspective which one I would prefer. I know from a shareholder's perspective which one I would prefer. We, as Australians, we should not be ashamed to say or embarrassed to advocate that we have banks that are profitable. I think what we need to shift through, and I think the inquiry over the last 12 hours clearly demonstrated that there is an appetite, and ANZ clearly led the way in addressing some of the issues that clients of the banks are raising with us. And to pick up on Matt's point before to say that we haven't spoken to clients, I mean, in and around that issue of credit card interest rates space, I can assure you that I took an enormous amount of commentary from bank customers who shared their concerns with me in and around where interest rate interest rate sat on credit cards at the moment.
Just before I go to Matt, I just want to ask you about credit cards, because I know that was the thing that you were really hitting hard this week. How confident are you that they'll go away now and cut credit card interest rates?
Well, you can only look at the Hansard and take at face value what ANZ said, that there's an appetite. Later in the afternoon when we spoke with Westpac, I mean, they agreed that if they were to give a cut in their credit rate space, that it wouldn't affect their profitability. We clearly articulated that what were the banks doing with reference to looking after their loyal customers. If there was a transient customers, they would drop their rates to zero for a prolonged period of time to make their bank more attractive. So I think there's real marketing space in that place, and credit cards touch a lot of Australians. Not everyone has an overdraft, not every Australian has a mortgage, not every Australian has a business loan, but most and sundry have a credit card.
So you'll be following this up at the next hearing next year?
I'll be following it up well before that with private letters to each of the CEOs encouraging them to consider dropping interest rates.
Matt Thistlethwaite, back on that RBA cash rate and whether the banks are mirroring those rises and falls. Do you accept their reasoning that because a lot of their funding now comes overseas and that's a bit more fickle, they need to have that play?
I don't accept that at all. I think that the Australian public don't buy that. The cash rate definitely is a determinant. It may not be the sole determinant, but it is a determinant of the rates that they set for their mortgages and their deposits. And we've seen that in the past in the announcements that they've made. But what was instructive, I think, over the course of this week was we were able to demonstrate that when rates go up, when the RBA lifts the cash rate, they put their rates up immediately. But when rates go down, they take a delayed response before they'll pass that on to consumers. And in the case of Westpac, it takes up to 20 days that it took for the last rate cut to be passed on, and they profit from that. They made close to $20 million just from delaying that rate cut being passed on, and that's why people are really, really upset with the banks. They see through these tactics and they see this in the earnings that they're making, and they feel that they're not getting fair treatment.
Scott Buchholz, I went and had a look at Westpac's decisions after those RBA increases and drops. In the 4 times that the rates were increased, it took them just 4.75 days on average to raise their rates. But when they had the drop, it took them, as Mr Thistlethwaite was indicating, 17 days on average. Can you do anything about that?
Well, I mean, this is part of this whole economics committee inquiry and asking them to bring their positions forward. Absolutely, I'm very robust and buoyant about the vehicles that are available through ASIC, APRA, the committee, the Ramsay report that's currently, the Ramsay review that's underway, the extra powers that the Small Business Ombudsman has. I think all pressure that will be brought to bear in conjunction with a tribunal will put enormous pressure on the banks and change the culture as the Prime Minister requests.
What about new products? I mean, there was a lot of talk about these rate tracker loans that are pegged to the RBA cash rate, whether it rises or falls. It seemed no one wanted them. Do you accept their reasoning behind it?
Well, I'm familiar with the product line that they are in the UK. In listening to the banks, they said that not a lot of the consumers pick them up. They're a wonderful product when your cash rate is trending down. They're an uncomfortable product when your cash rate is trending up. And given where we are in the cycle, that you would think for the next 20 years that we were going to see more rate increases than we are going to see rate decreases.
Matt Thistlethwaite, do you think the House always wins on this one? Because the banks seem to pass on the rate increases but not the drops, and so that's why they don't want the rate tracker?
Well, there's no good reason for them having a look at it, and it's done in other nations. They've been able to offer these types of products and legislate to ensure that they can offer these types of products. But the banks obfuscated on it over the course of the last week. None of them gave me a cogent reason as to why they can't offer these in the marketplace and make them work.
One of the other big issues, obviously, was the incentive-based culture around other financial products that banks have been plugging to their customers. Scott Buchholz, they say they're moving away from that incentive-based culture, but they're still retaining these league tables of their branches to see who's doing the best. Do you think the culture's changed there?
I come from a small business background, and I really struggle to understand where this boogeyman is with someone wanting to monitor the performance of their business. I think the examples that were given today are that if someone comes in and has got 3 or 4 different credit cards and they're paying 18% on each credit card, and that the bank teller says, well, I think you've got the wrong product, you've got exposure of $15,000 to $20,000, why don't we consolidate you into a unsecured loan with 8%, 8 to 14%, I think was the range they mentioned, and try and offer you some financial advice. I really don't see where the disincentive is for either the customer and or for the bank, who's shifted and potentially taken a net hit in their margin by shifting them out of higher percentage rates.
I guess it's whether you're working for the customer or against the customer in that regard.
Well, in the example that I've just presented, you can come to your own conclusion who are the beneficiaries of it, and I would suggest that overwhelmingly the customer is.
Matt Thistlethwaite, are you convinced that those instances where they're working against the customer are now eliminated?
No, I'm not at all. All of the banks still have some form of target for their tellers and their bank staff, and it comes down to that they have to try and promote or reference or sell a certain number of credit card referrals, a certain number of home loan referrals, a certain number of discussions about insurance. And in 3 of the 4 banks, their pay and incentives are linked to that.
Scott Buchholz, Matt Thistlethwaite, thank you so much for your time.
Thanks, Matt.
Thank you, Matt.